Hey, Mark,
Morning.
great to have you back, buddy. How are you?
Good. I wish it was better times.
Yeah, so I mean, you and I haven't talked in a while, and so much has happened. I mean, we had that, the tariff stuff and the 20% correction in S&Ps, and then the quickest recovery I've ever seen from that type of crash. I don't think COVID did it that fast, and all the geopolitical stuff happening here. How's it been for you? I know a lot of people are having a difficult time in these markets where one tweet changes the whole picture in 30 seconds. Um, how's it, how are you dealing and trading this? Are you trading less? Is it, do you have to go for shorter time frames or even longer time frames? Have you had to make adjustments? This, I guess,
Uh,
is a long way of saying what I was going to ask.
it's been a challenging time. I haven't really I've really pulled back trading, but I think it's a bit like I think you're right that the time frame is so important. Having to respect the time frame in which you're trading in. But sometimes, I think about how they taught us how to drive in the US. They say aim high in the steering. Which means don't just aim when you're driving. Don't just like target you're not looking at the pavement 10 feet in front of you, but you're looking down the road. And I think that helps me keep a clear, big picture view of things.
Okay.
And in that big
Okay.
picture, I think the dollar is going to fall much further. I think last time I was on, I was saying the dollar index was headed to 95, and I think
Yeah.
maybe a bit conservative. Maybe it's headed towards 90. I think that even now with this with the currencies, you're still looking at and I know you're gonna laugh because a lot of you are operating at a much shorter time frame. But if you look at a bigger time frame, and this is the only time it really counts, purchasing power parity, just a measure of valuation, the dollar is still, I should say, the euro is more than 50% overvalued and undervalued, I should say, and so is the yen. And so I think that a bunch of these forces are unfolding that the dollar's long-term downtrend will continue. I'm
Okay.
concerned though today, after we had Bowman and Waller, two
Yeah.
Trump appointees to the governor at the Fed, had talked about now a July cut. I think that
Yes.
Powell's testimony today before Congress is important. I think that he's going to sound more hawkish than they are. Remember, the dot plot is the ink is hardly dry, and at that dot plot from the June FOMC meeting, nine Fed officials either thought no cut this year or one. That's half the Fed. And I
Yeah.
think they're probably respecting that. I think that nothing has really changed from sort of the Fed's leadership point of view. The economy, they say, is still in a good place, and that buys them some time to wait for things to clarify. And I think we have to get past at least July 9th before things clarify with the reciprocal tariffs.
And there
I,
are no emergencies to
well,
ease. What's the emergency? We're almost at new all-time highs in S&Ps.
Yeah, I think that, a lot of the tariffs are being imposed on an emergency powers basis. So I agree with you. The Fed doesn't, I would expect Powell to say that there's still no urgency. Of course, every meeting they talk about should they change policy. So to have the discussion in July still seems to be prudent. I'm in the camp that thinks that the economy is weakening. I'm looking at the closest thing to real-time labor market, which is the weekly jobless claims. We're at the highest level. Whether you look at the forward moving average, you look at continuing claims, the labor market's deteriorating. And other ways to measure it, the intensity, full-time, part-time, all that kind of stuff. I think labor market's weakening. We're going to see this this week as well. Durable good orders. The headline's going to be jumping because of Boeing, but the underlying shipments, especially when you strip away commercial aircraft and defense, is another sign of weakening capex. And we've
Okay.
seen retail sales fall 2 months in a row. So I'm in a camp that thinks that the Fed's going to have to cut rates. I have it penciled in for September. An idea that the economy is going to be weakening and that's going to change how they assess the risks.
Okay. So I want to know if we're going to have, when they do begin to ease, the atypical reaction that we had the last time they eased, where yields on the long end of the curve actually rose quite dramatically after their last easing. If you look at the 10-year I have up here, Mark, we have a huge range for about, I don't know, 2.5, 3 years between, say, call it 420 and 460. How do you see this resolving if you're looking for lower rates? Do we just roll over here, take out 420 and head into the threes? Or is there one more push above this 460 level? And maybe even the easing is what does it if we have the same reaction.
I think partly it depends on what happens when the Fed does resume its easing cycle. If it is seen to be political, I think that's a problem for the long end. If it's seen to be reacting to, because the Fed does not do things preemptively, it appears, that if
Right.
it's a reaction to weak economic data, I think the market's going to like that. And especially you think about what's happening too with the changing some rules, regulations like the supplementary liquidity requirement, which allow banks basically frees up more, makes it more attractive to have treasuries. The stuff about stablecoin, that also the treasuries argue that's going to increase demand for treasuries. Now, I'm not so concerned that foreigners are not buying so many treasuries. We in America are, and I think that's really the key element here.
I know that you're in bonds.
I am long bonds. When I sold my New York apartment, I took the equity, and I'm in the typical ETFs for sort of the 10 year to the belly of the curve. I don't
Okay.
regret it. I mean, I don't want to take the risk with my principal. I want to buy another place, and so. I see that I missed an opportunity in the stock market, right? We're basically we could be setting up for new highs, like in the S&Ps, but uh,
Yeah.
to me, we have to figure out what part of our capital we want to put at risk and what part of our capital we want to preserve. And so I'm trying to preserve that chunk of the equity from my apartment sale. But I've been in the stock market. I've been what I've been I've been trying to play themes. So I liked. Which is now making new highs. Bombardier in Canada, I thought they're going to be tying up with European defense. I thought these medium-sized airplanes, I like that. I like BYD in China. I've been trying to play the uranium space with
Okay.
energy fuels in the U.S. Uh, so yeah, I try to play
That
these
was a
big
good one.
themes in equities. I'm participating with a bunch of the large hedge funds into the Fannie Mae and Freddie Mac, thinking that Trump is going to try to move to partially privatize them. So yeah, I play the themes. I try to avoid momentum type things, though, when I try to trade my own account in equities.
Okay. So weaker dollar, what did you catch any of the miner action? They were stellar, a lot of the miners.
Yeah, I haven't really been playing the mines. I am long some gold, though it's going to get hit pretty hard here today. Gold
Yeah.
doesn't like peace, but I think that when we saw what happened in April, many people, I think I think the political climate in the U.S. is such where something bad happens, blame foreigners as sort of the knee-jerk reaction. But what we see with the tick data is that it just wasn't true. Foreigners have bought more paper assets in the US, more stocks and bonds in the US this year, in the first 4 months of this year, than they did in the first 4 months of last year. And there's a really important BIS, Bank for International Settlements. You can find this free on the internet. They do some really good analytic work. And what they're concluding, if I understand it right, is that most of that sell off that we saw in April in the dollar was really not foreigners boycotting US capital markets because of the tariffs, but really hedging, especially from Asia. And what they do, it's kind of interesting. And I tried this myself many years ago. Instead of having a bar for every day, having a bar for the Asian session, European session, and the US session. So every day was 3 bars. And in effect, this is what the BIS has done, and they found that most of the dollar selling pressure came in the Asia Pacific time zone, and they conclude that it is was primarily hedging. And I think there's an important like insight here. We often think of the market as buyers and sellers, people who want to buy the asset or sell the asset, but there's a whole layer, especially the capital markets, of people who are hedging. Like
Yeah.
my clients at Bannockburn, they're corporates, they're medium-sized funds, and part of what they do is hedging receivables for corporations. They're not looking for
Right.
the best trade, they're looking to lock in prices below budget.
Right. Yeah. I mean, that's why the markets were created, not for people to trade their 5 minute tick charts.
Well, I think that it's a question of like to me, what happens is my clients are looking to offload some risk, and I suspect that many of your listeners take a piece of that risk.
Yes,
And so that's the importance. That's why we need a wide variety of market participants operating in different time frames with different motives. It's not like we all play the same game of maximizing profit. There's a whole group of people, a whole large market segments that aren't interested in maximizing profits. They're interested in locking in certainty, reducing uncertainty. And so
exactly.
you've got these people who are want to offset risk with people who are willing to take on risk.
That's right. So, Mark, I know you're looking for lower dollar. Can we get specific on, say, for example, do you feel that way about the commodity currencies? Because, we are getting a little bit of a bounce. You have levels where you'd look to be a buyer in euro. I know we've had a 2 day big run. If you were flat, what would you do with looking for currency trades here?
Yeah, so I think, like I say, for me, if I'm playing for the short run, like today, tomorrow, I'm looking for
Yeah,
Powell to sound more hawkish. So I agree with what you guys were saying earlier about trying to buy some dollars. So I would look for a pullback in the foreign currencies. But I think that for me, again, it's like I'm in a position where I don't have to catch every move. And what I try to
right.
do, having been having lots of scar tissue, I try to go with what I think is the underlying trend in case I get stuck the wrong in the short term. At least I've got the long term in my favor. Of course, yeah. So I think that even now, I think the market's being a bit conservative about where the euro can go. I was just looking at a Bloomberg survey for the end of the year, and I think they had it going towards 118 or so, which doesn't seem like a big move to me. I think
Yeah.
we could be on the other side of 120. I'm
Okay.
watching the 65.50 level. I think you guys mentioned that earlier in the Aussie. I think that the Aussie and to me Kiwi, they sort of trade like high beta euros. You tell me which direction the
Great
euros
metaphor. Yeah.
which way, right, the dollar is going in general. And I know
Yeah.
what we want to do is we want to be on the fastest horse. And so maybe it's long Aussie, short Kiwi. And maybe it's along the Scandies in a when you're bullish the euro instead of being just long the euro. Take a look at Sweden, maybe more so than Norway, just because Norway is more thinner traded. It's really more treated more like a petro currency. I typically don't buy that the Canadian dollar is a petro currency. In fact, in my work, what I find is that while sometimes, say, Canadian dollar could be influenced by risk off correlation with the S&P 500, could be more sensitive to interest rates. But I find that a lot of the currencies right now are correlated to the dollar index, even if they have a small part in the dollar index, like the Canadian dollar or the Aussie.
Yeah.
And so this tells me that we're having what's really a dollar move. And in a dollar move, a couple of things I think are typical. One is that the Canadian dollar lags on the crosses. So when the
Okay.
dollar is strong, the Canadian dollar tends to strengthen on the crosses. When the dollar is weak, like we are now, the Canadian dollar tends to weaken on the crosses. So that means that it's almost like a North American type trade. It hangs close to the dollar. It's actually got among the lowest volatility in the G10 currencies. So that's why I'm
Wow.
looking at things like that. The pairs, currency pairs that are highly correlated, like Aussie Kiwi or Swiss
Yeah.
Euro Swiss, and you just want to be on the faster horse and catching the trend in a weak dollar environment.
Okay. Uh, Mark, so what do we do? You say you wish we were in better times. How do you tune out what you feel emotionally? Because, people go, well, Dale, you watch too much news. Do you ever get that from people? Stop watching the news. How can we, with what we do, stop watching the news? And how do you kind of have some type of firewall up so that it doesn't blend in with your trading?
Know about that. I like it sounds like a different world than I live in.
Yeah.
If someone said to me, "Don't follow the news." That means ignore the fundamental factors. It'd be just as to me, it'd be just as insulting if someone told me, "Don't look at the charts. It's just
Yeah.
technical, it's numerology or something like that." I think that
Yeah.
trading, I think trading's difficult. I think trying to have a view about these things. I mean, it's not like a loaf of bread. You go to the grocery store one day and you get $3 for a loaf of bread. The next day, you go in the next week, it's still at $3. Currencies in the capital markets, we've got these. constant incremental changes. Sometimes they're not so incremental, like we've seen in the last couple of days. So for me, I think it's not so much like overdone on the news or fundamentals. But I think that what many of us lack, partly because of our education, is a larger framework to understand these things. Like I think you said earlier, when I was listening to the show, Dale, that these people in the Middle East have been at war with each other for generations, and
Yeah, eons.
so to appreciate that these kinds of truces, ceasefires are very fragile. Trump
Yeah,
had called this a 12-day war. I think that's really misleading in the sense that Israel
like
first,
it's over.
well,
Yeah,
yeah, not that that's over, but that it just began 12 days ago.
right,
Israel took out Hamas and
right.
Hezbollah, which are the proxies for Iran. And so the
Yeah,
war really began like a while back. And is it over? No, but I think that the important takeaway is not, even if this ceasefire doesn't hold, I think the market's fear that we saw at the end of last week of a World War III has diminished. The idea that Iran was going to close the Straits of Hormuz, that also seemed to be that scenario, that tail
yeah,
risk seems to be
right.
have been reduced. I think that rather than Iran closing the Straits of Hormuz, the greater risk was us, the private sector, insurance companies charging more to insure tankers going through that region, making it prohibitive, that raising the cost to make it to eventually a prohibitive level of shipping. Not that they were closed off because of missiles or weaponizing the straits, but rather the market responding to the heightened risk. So again, I think it tends to be it's sort of like what I was saying before about the hedging. If you really have to think, I think. About the markets, the capital markets, not as just buyers and sellers, but the much more complicated 3 or 4 level game of chess.
Yeah. So, you talked about the euro being maybe 50% undervalued, and you also said that you thought the yen was. So, one of the biggest levels I see, and the whole world will be watching 140 on the yen, right, Mark? Because all you have to do is look left, right? It could be a big neckline. I mean, it's come into play for about 3 years. Um, so
Right.
this would measure 120. Is that viable?
I think that's where we're headed. Maybe not this year, but I think that's where the direction we're headed. It's kind of interesting too, Again, why I stress like the time frame that we operate on is important, because it became a dollar move over the tariffs. The
Yeah.
dollar yen became less sensitive to 10-year U.S. yields. I think
Yeah,
that's oftentimes to me one of the great guides for the dollar yen is the U.S. 10-year yield, not the spread as theory would have it, not the short end, but really that 10-year yield. And in the last couple of weeks, I'm looking at a 30-day rolling correlation, and that is back to above zero point 0.4. It fell below zero point 0.1. So we are seeing gradually the 10-year yield come back as the underlying driver. And I think you have this on this chart too. The 200-week moving average
that's it.
for dollar yen just below 139.60 or so. So
Yeah, right there.
to me, this is a big topping pattern. Uh, what it takes to break through it, I think ultimately it's going to take lower U.S. interest rates. That's been one of the big shifts this year. How we've seen the market give up the idea practically of a BOJ rate hike. They try to normalize policy, but the amazing thing is this auto tariffs that the U.S. is imposing. The auto sector is about 10% of Japan's GDP, employing
Yeah,
about 8% of their workforce. This is a major blow. This risks, I mean, the Japanese economy is weak. It already contracted in Q1. It's not off to a great start in Q2. And these auto tariffs is it's like just a big weight. I think an obstacle to the BOJ normalizing policy. They're going to take a step back from the unwinding of the balance sheet next year. The government is reducing the supply of the long-term bonds. They're
right.
trying to respond, but the weakness of the economy is really preventing the normalization and the U.S. tariffs. I mean, it's not just the autos, but especially autos for Japan, but steel and aluminum as well is really going to be a challenge for this normalization of Japanese monetary policy, which means that we can't count on the Japanese side of the equation, Japanese higher rates, to support to drive the dollar yen lower. It'll have to come from lower U.S. rates.
Or how about risk off? Safe haven currency?
Yeah, but we just had, well, I think the safe haven currency is a bit exaggerated. Here's what I sort
Okay.
of see happening. Typically, why does the yen or Swiss franc rally when the world's melting down? Not because people are buying these currencies because this is a great place to hang out. They're buying the currency because they have to, because they're short those currencies like the
And
Swiss.
the carry trade.
Exactly. In fact, it's not just a carry trade in that strict sense, Dale, of people looking to pick up yield. But when you or I, with our own money, we're buying a currency, we're buying stocks, we want that asset to go up. But large pools of capital don't have to do it that way. It's OPM, other people's money. So they
That's
fund
right.
the long S&P trade or the long treasury trade, not with their dollars, but by borrowing yen or Swiss francs, for example. This is the so to me when those high risk assets go south and eventually they do, you have to buy back the funding currency. What's interesting to me though is the yen is not being used as much of a funding currency right now as the Swiss, and partly remember what the Swiss National Bank did earlier this month. They cut their interest rate to zero. They've got negative inflation. Japan has the highest inflation in the G10, and Switzerland has the lowest. And they've knocked their interest rates 50 basis points below the Japanese. So for these funding currencies, you use the Swiss franc, the dollar,
Right.
and maybe even the Chinese, the offshore RMB.
Okay. I think you mentioned that last time. You mentioned the yuan as a funding currency last time we were together.
Yeah, I think
That people
that's
were,
something that, it's just as a tool in our toolkit is uh, is which currencies are good funding candidates. And I think that's the interesting thing that's happened this year is that uh, the dollar, because people's bearish views of the dollar, I think that the dollar has become the funding currency, which is why we rallied so sharply. And as soon as the market had a hint that this was theater, and like I was trying to write in my commentary today, it's not clear when the theater began. I sort of suspect it began over the weekend, when the U.S. dropped those
yeah,
mother-of-all bombs, those bunker busters, a dozen of them, and on the sites that were on everybody's maps. And so it seems now even more credible that the Iranians moved the
yeah, of course.
uranium outside of that area. So the U.S. Display of force was simply that. And then
Empty.
when the Iranians struck yesterday, there was also well telegraphed, well within this theater of de-escalation. And so I think that's really the takeaway. Even if this ceasefire doesn't hold, it's really been de-escalated.
Okay. Well, that is good news. And what else is good news is that people could follow your work and not wait 3, 4 months for you to be here on Face. And Mark, just listening to you, and I usually talk more during interviews and
Great.
interrupt people all the time. And you had me listening today, and I feel edified. And uh, some things that I was considering, you know, don't hold water to what you were saying. So always appreciate you visiting us and coming in and educating me, professionals, and our traders in our community. Um, like Blake says, you're one of Face's favorites, and it's
Taylor,
great.
I appreciate FX Analytics, just the support you give me over these years. And I sort of feel like it's not like I have despite like a lot of gray hair and over 30 years of experience, I don't it's not that I have found any secret way of success. I think I really identify with this quote from Thomas Edison. He said he didn't fail. He found 10,000 ways it didn't work. I have found a lot of dead ends. And I just hope
Yes,
that through my work I could share like stumble on another one. And I kind of think
yeah,
I think that's the way it works in the sense that it seems to me that there's only three ways to make money. You either go with the trend, you fight the trend, mean reversion type strategies, or something like this carry trade. But there's lots of ways to lose money, and I think I keep finding new ways.
yeah. Anyway, embrace our failures because
Yes.
our greatest lessons are from those. And it's never a failure to have a conversation with you, Mark. Thank you so much for hanging out with us for a half an hour. Everyone go to marktomarket.com. Follow Mark on X at Mark Making Sense. so that you stay abreast of one of the best thinkers in FX, in my extremely accurate and humble opinion. All right,
Very
buddy. All
good
right,
details.
my trading warrior brother, Marc Chandler, everyone. And thanks again, Marc. Everyone have a great day. Good luck. Let your trades breathe. You don't have to trade. No one's putting a gun to your head. If there's nothing compelling, sit on your hands. I guarantee you something will hit you in the face that you won't be able to stop yourself from doing. Wait for those. And most of all, don't just count your pips, count your blessings. Adios, everyone. See you tomorrow. Thanks again, Marc Chandler.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.